40 years, more than 500 billion US dollar invested by private capital and asset managers from the Gulf and the States. Over the last year alone, more than 40 billion. And GFH by itself have undertaken more than 10 billion over the last couple of years. Bahrain hosts some of the flagship asset managers, GFH and Viscorp, which they have started this trend and line of investments in the Gulf. And now we see a lot in Saudi Arabia and Dubai. So it's an opportunity. We thank the guests for being here with us today. We invest also through them and in partnership with them. And it's an opportunity to discuss this topic.
Amazing. Thank you. Hi, everyone. Good afternoon. I'm Lauren Keel. I'm the Global Head of Community Innovation for Bloomberg Media. Very excited to be here to moderate this panel today at the inaugural GFH Bahrain Pavilion. We are going to talk so much about what Hisham just shared with us about thinking about how the Gulf Cooperation Council countries are thinking about the economic growth within the countries and how, in particular, they are investing externally. We're going to talk a lot about the U.S. today, other growth markets that they're focused on, and we're also going to talk about how those markets are investing back in Bahrain. So look forward to hearing more from all three of you. I've got an amazing group of panelists. Hisham Al-Rayes is the board member and group CEO of GFH Financial Group. Next to him, we have Wei Li, who is the Global Chief Investment Strategist for BlackRock, and then David Rubenstein, who is co-founder, co-chairman of the Carlyle Group, also a host for Bloomberg Television. Thank you all so much for being here this afternoon.
Thank you.
So Hisham, I'm going to start with you. You gave us a little bit of a sense of this, but there's a very strong amount of foreign direct investment happening into the U.S. from Bahrain. It was about $702 million last year, significant growth from 2022 to 2023, about a $79 million increase. So it's a huge growth opportunity. I know GFH is strongly focused on the U.S. What's driven that focus? Why are you so interested in the U.S. market?
Yes, GFH is a large investment bank based in the Gulf. We are listed in 4 markets, beside Bahrain, Dubai, Abu Dhabi, and Kuwait. We manage 22 billion assets under management. We promote for the high net worth individuals safe destinations for investments and for wealth preservation. So we typically go to lower risk asset classes, which they pay regular dividends and has a moderate growth opportunity that preserve at all time their wealth. And U.S. has always been the preferred destination for us and for clients for several reasons. One, you have the currency, depth of the market, experienced asset managers. They are leading trends worldwide and hence creating the opportunities. Throughout the years, we see different cycles, and each cycle you have experienced asset managers and a lot of capital backing it to create size, liquidity, which allows for a safe investment for our clients. And hence why it has always been, I think, for the Gulf and also worldwide, the choice number 1.
And David, what do you think in comparison to other markets? What makes the U.S. an attractive destination for Gulf capital? And how do you think that's going to change over the next couple of years?
Well, the United States is the, I think, leading place to invest money in the developed world these days. We have post-COVID, we have soared past every other developed market in terms of growth, in terms of our technology development, and I think the rates of return that people have achieved have been quite attractive. Europe has not been quite as attractive a market for investment because it hasn't recovered from 07, 08 problems, hasn't recovered from COVID, and hasn't recovered completely yet from the inflation problems of the last year or so. So I think Europe is lagging behind, and I think other developed markets, while they have some appeal, nobody has been able to catch up with the United States really in terms of being able to have large amounts of opportunities. 2, you can invest in a currency that's the reserve currency of the world, so it's pretty stable. Three, there are just so many new technological developments going on in the United States. Just to cite artificial intelligence as one, the United States is the dominant player in artificial intelligence, and that's going to be the dominant technology for the next 10 or 15 years or so. So I think the United States is extremely attractive as a place for Gulf money to invest. I would add, though, that the biggest change that has occurred in the Gulf in terms of investment activity between the two regions, the Gulf and the developed markets, is that now the Gulf region is much more interested and focused on getting money from the developed markets, particularly the United States, to invest back into the Gulf, to diversify their economies outside of oil and gas. And I think that is working pretty well.
Wei, I want to bring you on the point that David just mentioned about diversifying economies and how the Gulf countries are thinking about reducing that oil and gas dependence, where they can grow more. What opportunities does that create for investors like you at BlackRock?
Infrastructure, that's the short of it, but building on the capital back to Gulf region, BlackRock is playing a big role in that. We have a big and growing presence in the region. A few examples of that, specifically in the context of Bahrain. We took a minority stake in the Saudi-Bahrain pipeline company, with Babco still the majority holder, but we have a MOU around kind of focusing on infrastructure build out. Another example, the global AI investment, infrastructure investment initiative project, which is very much the intersection of AI, energy build out, data center. The initial plan is to have $30 billion to invest, identify projects within the region and beyond. And we're expecting that to grow to $100 billion once you account for the debt financing piece. So we're very excited about the opportunities in the region with intersection very much meeting at infrastructure.
Now, let me just add that one of the major changes is that about 15 years ago, when Carlyle had a fund to invest in the Gulf, we found it very difficult to find things in which to invest. The families that owned things for generations weren't interested in selling them particularly, and the governments weren't particularly interested in selling assets they owned. That's changed now. I think families and other government entities are selling things, if not control, they're selling significant minority stakes, which is attractive enough now to private equity firms and growth capital firms to invest in. So you're seeing money going both ways, and I think that's a big plus for both sides.
I would like to add that throughout the years, since a lot of the private and investment firms in the Gulf, they have been investing, they got exposed to the governance structure. There was a transfer of experience and knowledge. And hence, this has developed also the industry investment landscape in the region, which made it easier for
well, it's also been aided by the fact that many people in the Gulf who are natives of Gulf countries have been educated in the United States or trained in the United States. So they either went to school there, business school, or they've been trained there in various investment firms. And so they've gone back to the Gulf, and because it's a very attractive place to live, as we all know. The tax rates are pretty attractive to live there. And I think it's a much more conducive place to live than it might have been many, many years ago. Saudi being a good example, how they've changed things dramatically. Bahrain had already changed some things before. But I think you get very talented people who've grown up in the Gulf, gone to the United States to live or go to school, and now they're moving back. And their expertise is, I think, facilitating a lot of this.
I would like to highlight that U.S., though remain for the GCC, remain, despite the coming and attractive local opportunities, remain still the first choice for investment due to the depth and ability to exit due to liquidity and multiple asset managers, different classes. And this is the challenge we find also when we invest, for example, in Europe, is that you can find a good asset, but ability to monetize and to exit after a period of time is always a challenge.
Well, Europe is an attractive place to live, to vacation. I don't think there's a better place in the world to spend the summer than the Mediterranean. The restaurants are great, the culture is great, the art's great. If your principal focus is exiting an investment of size on a timely basis, Europe might be challenging a bit, as we all know. So I think the United States, without bragging, because I'm an American, but I do think it's fair to say the United States has lapped most of the developed world in terms of being a place, it's an attractive place to invest and encouraging investments as well. And one of the other changes that we should talk about is that the wealth in the Gulf is not going up and down as much as it may have done many, many decades ago. It used to be the case in the let's say early 1970s, that the price of oil was roughly $1.25 a barrel. And then when the boycott occurred in the 73 area period of time, prices of oil went up 400%. So think about that. If oil prices today went up 400%, you'd be at $280 to $290 a barrel. That would not be sustainable. But today, prices have been fairly consistent. I don't know, is that a march?
Sounds like we have a musical interlude here.
Oh,
But
okay.
While we have that going on, we're going to take some questions from you all in a minute. So have a think if there's anything that you'd like to ask our panelists. I'll turn it over to you in just a minute to ask them some questions. But before I do, Sham, I think we already have talked about infrastructure, and Wade mentioned that as a really attractive market, attractive industry. I know a lot of the investments that you all have made in the U.S. have. We'll give them just a second to go by.
Yeah, for those who might be watching, there's a protest here. People think there should be more money invested in the Gulf, and that's what people are protesting. They don't think there's enough money being invested in the Gulf.
Amazing. Okay, I wanted to ask you about the infrastructure piece that Wei had brought up. It's been a big area of investment for you all in the U.S. Why that industry? What about student housing, logistics centers are appealing to you?
Yeah, we have been realigning our strategies throughout the years. We have a number of themes that throughout the years are consistent, which is student accommodation, the medical complexes, which are live essential assets. We continue to invest, US continue to grow. However, there are additional themes that we have added, which especially with the pandemic, a lot of investments we have done in the logistics, and this has contributed very well. And all those trends, they have all those assets, they deliver a stable return, cash on cash. There's always demand, ability to exit. Especially with our partners in the US, it's easier to manage and administer. Then we have added the private credit, where we have seen the demand with the inflation and interest rate, and we started investing. Carlyle, a couple of very successful transactions in private credit and with other asset managers. And now we are focusing on data centers and the power generation, whether renewable or private. And the new cycles also stimulates the appetite of our clients, because they like to add new asset classes to their portfolio. So US continue to amaze the clients with the new attractive investments and new themes that they would like to add to their portfolio. A lot of interest last year in data centers. There is a lot of interest, however, to choose the right partner, to choose that they are able to secure the right opportunity, the capacity leasing is not as simple. So you have to choose the right partner, the right asset manager, and yeah, so.
David, do you think with the new U.S. administration that the industries that are attractive in the U.S. for Gulf capital are going to change?
President Trump thinks so. Look, President Trump is very popular in the Gulf. I think for a lot of reasons. He has done something that very few presidents have been able to do, which is to be popular in Israel and also be popular in the Gulf at the same time. That's not easy to do, and he's managed to do that. He's also very focused on getting people to invest in the United States, and as we saw the other day, a Dubai business leader committed to invest $20 billion in the United States on data centers, and I think that's the first of other kind of announcements you'll see that are along those lines. So clearly, one of the ways to keep President Trump and his administration happy is to commit to invest in the United States. And I suspect that will also lead to more and more people in the United States putting more money into the Gulf. And I should add that it's easier to do business in the Gulf than it was years ago for companies that want to transfer things. And this is the reason. If you have an automobile company, and let's say a Gulf country wants to build an automobile company, you got to build a factory. You got to get a lot of trained workers. It takes a lot of time to build those factories and get everybody trained and get all their parts in. In technology, you can sit behind computers and do a lot of the work through software and other kinds of things that are not as difficult to build from ground zero. And so I think you can see a lot of technology transfer, particularly in the AI area, working in the Gulf, where it's easier to get those things translated and transformed over into the Gulf than it would have been an automobile manufacturing or steel manufacturing facility.
And Wei, are there other growth sectors that you anticipate emerging over the next couple of years?
In the US?
Yes.
Or
Yeah.
Yeah, so just building on a sentiment around kind of how the US represents better opportunities, exit opportunities and broad, we definitely see that being a theme. Especially at this Davos, I was just reflecting on my first few days of impressions, and I think the embracing of U.S. exceptionalism is coming through really, really strongly. We were just joking about it in the green room that this is 6 hours ahead of the U.S., but it feels like this 6 hours behind because we're reacting to U.S. dynamics, right? So as we think about U.S. investing, focusing on fundamentals is really important. U.S. markets have outperformed both in terms of price, in terms of growth, the last few years. So the typical question that I get as an investment strategist is that, is it becoming too expensive? Is it becoming too expensive? Is it too late to get into the US market? We still think that there is runway for AI to carry US market further forward. If you think about tech, valuation is not that stretched in the context of very strong forward earnings upgrades. If you think about AI adoption broadening out, there are sectors, financials, healthcare, that should benefit from AI build out. At BlackRock, we prefer to think about the world through the mega force lens, through the structural lens, because the cyclical playbook doesn't quite apply in an environment of transformation, right? So people look at what's happening in the economy. There are things that are not quite adding up if you apply a cyclical playbook. For example, how can we have unemployment increasing last year but recession not really happening? So the fail-safe cyclical signals are not working anymore. This is an environment that requires a new playbook. And against that backdrop, mean revert as a strategy, it doesn't quite apply. People look at the US market too expensive, but if the composition of growthy sectors in US equity market are becoming larger, then surely the broader market requires a more growthy type of multiples, right? So you look at Magnificent Seven, pre-global financial crises, they represent 5% of the index, and now they are 35% of the index. So we need to reflect that transformation in our market outlook, and through that lens, US is still screening quite positively.
It's the point you were just making. Right now, in the S&P 500 index, 35% of the value of the entire index is 7 companies. So it's a lot of concentration. And if you were to take those out, the S&P 500 would be up a very modest amount, relatively speaking. But those companies are very significant. They're not likely to go away soon. One of the things people should think about is these American technology companies are almost like countries, when you think about it. Because right now, you can't go through the day, almost anybody here, anybody watching, you need American technology to get through the day. Amazon, Apple, Netflix, Google, Facebook. It's hard to get through the day without using one of them. How many European technologies do you need to get through the day? Spotify. Not that many. So what's happened is the European company have not been technology leaders as way that the American ones have been for a lot of reasons I can explain. And so these technology companies are almost like countries in themselves. They're so powerful. In fact, at the inauguration the other day, who was standing behind President Trump and his family? It wasn't European leaders or other foreign leaders. It was, with one exception, was one businessman from Europe. There's Bernard Arnault. But generally, it was the leaders of the major technology companies because they become like countries unto themselves. And that's probably going to continue for a while.
The incredible thing about these 7 companies is that they have negative net debt. So in the context of higher rates for longer, they are quite resilient to rate repricing. And I would say that to your point about concentration, I think concentration is a feature of this era of transformation rather than a bug of this environment.
Do we have any questions for our panelists in the audience? Would you just introduce yourself at the beginning?
So, now I'm Mustafa, I work for GFH and real estate. So with all these positives about the US, the concern right now from a lot of investors is the impact of tariffs, inflation, the size of the government debt and its implication on bond yields. So your thoughts on that?
Well, that's a complicated question, but let me try to address it. Inflation has not gone down as much as the Fed would like. The Fed would like it to go down to within sight of 2%, but it's probably a little bit below 3%. So they're still not going to be cutting interest rates as quickly as they once thought they would. The biggest challenge for the U.S. economy is one you put your finger on, but nobody but me and a few other people seem to be talking about it as much. Not just me and others, but it's the U.S. debt and deficit. We have an annual budget of roughly $8 trillion in the United States, and we borrow about $1.8 to $2 trillion for that. That's not sustainable for any other country in the world to borrow that much on a sustained period of time. Our debt to GDP ratio is roughly 130%. The only other country other than Japan, which is unique, that has a debt to GDP ratio like that is Italy, and that's not the role model probably for the United States. So we have too much debt, and we now have 36 trillion of it. How are we ever going to deal with that? Nobody really knows. President Trump hasn't really addressed that in the campaign. He's going to try to cut some spending with Elon Musk's project, but it's going to be difficult to do. The reason we're able to get away with it is because we're the only reserve currency in the world. Yeah. If there were 5 reserve currencies, people wouldn't buy our dollars as much and we couldn't borrow as much, but that's not likely to change anytime soon. I think the debt and deficit didn't come up very much in the campaign. People don't talk about it that much because there's no easy solution for it. I hope that we'll address it at some point in the next year, but it's a looming problem. But it's one of these things, just like the weather. Everybody wants to talk about it, but nobody wants to do anything about it.
I think we had another question in the front.
Hi, Ian Lindsay, advisor to Crown Prince Salman, the Prime Minister of Bahrain. I completely agree with you, David, in terms of the US, the strength of the US as an investment destination. I spent most of my career in Asia, and I think the future is very Asian. But then we've also got the States, I think, with strong fundamentals. But you've already alluded to the fact Europe seems to be yesterday's news. Notwithstanding we're in lovely Switzerland in the heart of Europe, Europe looks like it's going backwards. I don't agree with Viktor Orban very often, but that sense that Europe is sort of becoming increasingly irrelevant. Europe's share of global GDP has shrunk massively in the last 2 decades. So my question to you from an investment perspective is, whither Europe?
Before the COVID, Europe, which has about roughly 220 million people more than the United States, had a GDP that was higher than the United States. Now the GDP of the United States is roughly 30% higher than Europe's, because in the last 5, 6, 7 years, we've just zoomed forward and Europe has stayed where it is. Some people refer to Europe now, when I talk to them, they call it the museum continent.
Yes.
You know, it's living in the past to some extent. As George W. Bush liked to say, the problem with the French is they don't have a word for entrepreneur. Look, the internet was really invented in France. They had the Minitel, which was in effect the internet before we ever heard of the internet in the United States, but they didn't pursue it as aggressively as maybe they should. So now Europe is falling behind. Still, if you want to live a nice life, you've got a fair amount of money already. You want to not, have a lot of challenges. You don't want to worry about crime. You don't want to worry about a lot of other things. It's a great place to live. But Europe's challenges are these. There's no one person who's really a strong leader in Europe right now. 2, I think when the UK got out of the EU, it was terrible for both EU and the UK, and that's not going to change. You still have about 20 different fiscal policies and one monetary policy. You don't have a common currency still, because you still have the pound, the euro, the Swiss franc, and the Scandinavian currency. So Europe should do some things that would make it more relevant in the global economy. But I'm an American, so I don't think anybody in Europe's going to listen to me. But I do think as a place to invest, I regard Europe now as an emerging market, which is to say you're going to find things that are going to be some high growth opportunities in certain sectors. Carlyle has made a lot of successful investments in the fashion area in Europe. We invested in Montclair, for example, when we only had 1 or 2 stores. Now it's all over the world. Other companies like that we've invested in. So I think there are a lot of good pockets here. And clearly, Bernard Arnault, who I referred to earlier, has been a brilliant businessman building the biggest luxury company in the world. But I think Europe is challenged a bit. And I guess the final point I'd make is, a lot of young people, when they're growing up in the United States, their mother would say to them, oh, Johnny or Jane will grow up to be President of the United States, or John or Jane will go up to be a millionaire, or now a billionaire or something. But you don't hear parents in Europe saying, I hope my little boy or girl grows up to be a billionaire. They would say, let's go hunting on the weekends, let's spend time in the Mediterranean in the summertime, let's get our 2 months of vacation in July and August. And it's a different mindset. And I'm not saying it's worse, it's just a different mindset.
I would just observe from an investment perspective in the same way that U.S. exceptionalism is a bit of a consensus walking up and down this promenade. Depressed sentiment towards Europe is also a bit of a consensus. And that makes me wonder, maybe the bar is very low to surprise on the upside. Maybe just one of those catalysts that needs to happen could lead to a bit of a turnaround, right? So yes, on the risk asset front, European equity is less positive, but there are selective opportunities within that, like financials, for example. But on the bond side of things, ECB is probably going to have to cut more than the Fed. Certainly will have to cut more than the Fed, given the different growth dynamics. So income assets within the fixed income space is not too bad in Europe, in my view.
So if you're thinking of investing in the Gulf, there are a lot of good opportunities, but I would think people should invest alphabetically. So Bahrain, why not just go down the alphabet? And so, Bahrain would be first, right?
We like that.
I think we have time for one more quick question.
I don't know if it'll be quick or not.
Quickly, yeah.
I'll try to be quick. Thank you, Mr. Reis, for hosting us with this team here and having esteemed panel, of course, Mr. Rubenstein and Mr. Wee. Just a quick comment, if you don't mind, regarding the internet with the French. I was reading about the Panama Canal and the new Trump, opinion about geopolitics and taking over the Panama Canal. And I found out that the French were the first to build it, amongst others. I was reading yesterday night, actually, and they, amongst others, and they lost their shirt doing it. Quick question regarding trade with the United States, especially with your neighbors, Canada being, NAFTA and Mexico. That's number one. Talking about businesses in the fashion, I recall Carlyle also successfully invested in a lingerie business in Brazil many years ago. Other than
wasn't our best investment.
I know that. So
I think the investment committee was more interested in it than the investment results.
I remember the less was more those days. So less fabric for more returns. But anyway, I remember that one. Good thing I wasn't invested in that one. Anyway, thank you.
On the Panama Canal, I worked in the White House when we, quote, gave it back to Panama. The reason Carter did it, and Ford and Nixon have wanted to do it as well, is that our military didn't think we could defend it anymore. There were terrorism attacks that were threatened. There were some that occurred because people in Panama just thought it deserved to be owned by the country where it was residing. I don't think, I'd be very surprised if the Panama Canal will revert to Panama in my lifetime. Panama Canal has its challenges, which is to say, because of global warming, there's some water shortages from time to time there. Sometimes there are ships now that are still too big to go through the canal, and so they still have to go around Latin America and so forth. So it's not the engineering marvel that it was when it was first built. It's still good, but I don't think the United States is going to send military troops in to secure it and take it back. No.
We're just about out of time, so I'm just going to give Hisham the last question here. We've been talking about inflows into the Gulf and then back into the U.S. So if you had to make one investment into the U.S. now and you had to make one investment into the Gulf, what asset would you prioritize at each?
In the U.S., the supporting infrastructure for AI, I think it's a safer play because all AIs will use the infrastructure, but not all AI will succeed. So we like to preserve the and play it safe. In the Gulf, invest with GFH.
Thank you so much.
I should have said invest in private equity firms.
Thank you very much.
Shukran. Thank you.
Thank you.
Thank
That was fun.
Thank you.
Thank you.
Yeah, I'm gonna
Thank
go.
you. Thank you so much. Great to
Shukran.
meet you. That was wonderful. Thank you so much.
Get my coat. You know where
See you Friday. And then we find some time.